this trade is the biggest macro trade of all time. And it's not just about this cycle. It probably goes into 2030 and maybe well beyond that. So it's a big one. So anyway, pay attention, everybody. I'm going to start to go through the charts of why this is the biggest macro trade in history.
Hey guys, welcome back to Everyday Finance. In this video, Raoul Pal discusses Bitcoin and crypto. Bitcoin has an extensive price history and is remarkably correlated with global trends. As a financial analyst, it is evident that liquidity is a crucial factor to consider. Bitcoin exhibits a correlation of 87.5%, which is lower than that of the Nasdaq. This correlation is influenced by periods of outperformance, which tend to decrease it. During the phases of cryptomania, when the asset experiences exponential growth driven by technology adoption, the correlation tends to be lower. Liquidity, along with technology, plays a crucial role in driving Bitcoin's performance. Comparing Bitcoin to global liquidity, it has outperformed debasement by an impressive 105% annually. In contrast, global equities have shown no significant movement. Please consider taking a moment to support this video by liking it, subscribing to the channel, and enabling post notifications for similar content in the future. Please feel free to contribute to the discussion by leaving your comments and observations in the comments section below. Thank you and enjoy the video.
I've basically dedicated a lot of my life to this trade now. And many others in the space, particularly macro players, have basically just given up trading other instruments and just gone towards crypto because the world, driven by the everything code, is basically all one trade, the debasement of currency by the central banks, and therefore you want to own the best performing asset. And if the world is that simple, it really does make things much easier for us. Now, this is not for everybody. Not everybody wants to take the kind of risks, but this will give you a very good idea of why this is the biggest macro trade of all time. Now, when I first wrote about it in GMI back in 2012 or 13, I said it then. And I stupidly should have just dropped everything and just done this one trade, but I didn't. But really, I've been in it full time since 2020. The sell-off in 2022 was the opportunity I was looking for to add to the trade. I don't believe that if you've got a long-term view, you should really try trade around it. You should just keep compounding. But others think differently to that. And I don't know what I'll do this time around. I'll probably take some lifestyle chips off and continue to run the trade. This trade is the biggest macro trade of all time. And it's not just about this cycle. It probably goes into 2030 and maybe well beyond that. So it's a big one. So anyway, pay attention, everybody. I'm going to start to go through the charts of why this is the biggest macro trade in history. Firstly, I'm going to start with the everything code. The everything code is the proprietary thesis that we built at Global Macro Investor that we actually now run our portfolio for XPAM, investing in the very best hedge funds. We use this everything code as the basis. And it's the one where I discover that the debasement of currency is kind of everything and how it's very cyclical and it's understandable and forecastable as far as we can tell. Obviously, things can change. Nothing is a pure, perfection. But I think this is right, and it seems to be proving itself out right. So firstly, we observe that over time, the trend rate of GDP growth has been falling in the United States and all around the world. Current trend rate of GDP growth is about 1.75%. Why is it falling? If you remember, trend rate of GDP is driven by three key factors. 1, population growth. 2, productivity growth. 3, debt growth. So let's address these three factors. Firstly, let's have a look at productivity. Productivity has been declining over time as the workforce has been aging, and that lowers the trend rate of GDP. Debt, on the other hand, has been rising. But what we find is that household debt growth actually stops in 2008 because the banks just stopped lending to people. So it's just harder to accumulate debt. Also, corporates have also been paying off debt and have really not been growing as fast as GDP. But really, a lot of the debt growth is now driven by the central banks, as we all know. Currently, the US is running massive deficits and is financing it by issuing yet more debt. And we'll come on to that in a minute. But the key thing here, the thing that drives everything for the everything code and the world around us, the return on assets, the inflation, everything is driven by demographics. So here's the working age population, aged 15 to 64, trend rate of growth. It's been declining over time as the population ages. Those people are less productive. The older you get, the less productive you are. They had borrowed debts in their early years and now are debt tapped out. So this explains a lot, and I've talked a lot about this on Real Vision in the past.
The price of Bitcoin started to rebound on April 18th, reaching the $63,000 mark as BTC spearheaded a market-wide recovery in the cryptocurrency space. The price of BTC experienced a rapid increase on April 18th, starting at $60,000 and climbing 5.5% to reach an intraday high of $64,800. The recent upward movement has managed to recoup the losses from April 17th, leaving traders to ponder whether the retracement has come to an end. In a post on April 18th, market intelligence firm Santiment reports that the sentiment of the crypto crowd has become bearish due to the recent decline in Bitcoin price. The firm presented a chart illustrating the ongoing negative sentiment from the crypto community towards Bitcoin and other major tokens like Ether and Solana. The crowd has consistently expressed a bearish outlook on these top caps, further reinforcing the argument for additional caution. By analyzing the chart, it becomes evident that the frequency of bull market or bull cycle references on crypto social media has decreased since March 14th, when Bitcoin reached a remarkable peak of 73,835. Simultaneously, there has been a consistent rise in the number of bear market or bear cycle mentions. In the past, there has been a noticeable pessimistic sentiment among the crowd. According to analysts, market bottoms are often characterized by a shift in sentiment, where prices tend to move in the opposite direction of the prevailing mass sentiment. Anticipated market performance. The sudden decline of hashed folk, along with a significant increase in hash FUD, presents an encouraging combination that suggests cryptocurrency might experience a potential rebound either just before the HING or shortly after, despite diminished expectations of a Fed rate. The BTC price has experienced a 10% weekly drop due to cuts in 2024 and the increasing geopolitical uncertainties at the time of publication. Let's back to the Raoul Pal interview.
But we can also project forwards. And if you remember my piece about the retirement crisis, I've been introducing this chart for a while, which is the labour force participation rate versus the births-deaths rate. This is the births rate going forwards by 14 years. And obviously the birth rate drives how many people in the labour force over time. And it suggests that participation in the labour force should continue to fall over time. Now, we've had some pickup as part-time workers have come back into the workforce because people don't have enough money, and we'll see some of that too. But over time, we're going to see the labour force participation rate falling because the replacement of new people in the population is not as much as people leaving the workforce. And that is the problem that slows economies. It's affected Japan, now affecting China, South Korea, Taiwan, and most of Europe. So anyway, that is the megatrend. But this megatrend has some special qualities. When you strip everything out, and I keep saying demographics is everything, you find that the labour force participation rate is exactly mirrored by US government debt as a percentage of GDP. So what it says is as the less people in the labour force, the economy slows, but there's all of the services to pay for the old people, the government debt increases. That correlation is stunning, and that is an incredibly powerful chart to understand the world we live in today. Why governments keep issuing debt. And eventually, when they're having to print money to solve it, it's all a function of population. So what they do with that debt is they add liquidity into the system. That's the debasement of currency that I've talked about. And you can see the correlation between Fed net liquidity and the US government debt as a percentage of GDP. They're basically the same thing. Yes, the scaling's different, but overall, the trend is the same. So they're using liquidity to pay for the growth in debt by debasing the currency. It's called financial repression.
Data from Alternative.me, a platform that tracks emotions and sentiments around Bitcoin, reveals that despite a significant decrease from last week's value of 76 and last month's figure of 79, when sentiments were in the extreme greed zone, the crypto fear and greed index still remains in the greed zone at 57. Many market analysts, including a pseudonymous trader, in a recent post to their 453,000 XF followers, Rec Capital has indicated that the upcoming months may present a limited opportunity for investors to acquire Bitcoin at discounted rates. They suggest that this window of opportunity may close after a post-halving rally event. According to Capital, the current Bitcoin price action is following a pattern that has been observed in previous instances. According to Cycles Rect, the recent drop in BTC's value, where it fell over 14% from its record high of $73,500 on March 13th, was actually anticipated. They had predicted that Bitcoin might go through a retrace before entering a reaccumulation phase after the upcoming halving event on April 20th. Once Bitcoin breaks out of this reaccumulation phase, it is expected to enter a parabolic uptrend. In the past, this phase has typically lasted around a year, specifically 385 days. However, due to a potential accelerated cycle currently taking place, it is possible that this figure may be reduced by half in the current market cycle WCK. If you learned something from this video, then please like this video and subscribe our channel Everyday Finance, and we will meet in next video. Thanks.